My next guest sees more records ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. Fundstrat's head of research, Tom Lee, is here. He's a CNBC contributor. It's great to have you here, Tom. What do you see going on here?
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit, the software stocks. And as that fell, we know there were record inflows into software. And of course, the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff lows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were, you think, kind of going the other way this time.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. They didn't really know how big this war could become. Their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing, because there were too many people warning about the tail risks of that.
Is it possible they're right? I was in a store earlier today and the radio was on. I haven't heard the radio in a long time. And the DJ it was some kind of pop or kind of broad station. And he was saying, another check on gasoline prices, and boy, aren't they high? And I thought, wow, that's the first time I've heard gasoline prices talked about in a non-business news context in a while. Is it possible that actually there is going to be a bigger impact here and the retail investors actually know that and maybe the pros are missing it?
Anything's definitely possible. One thing that we were at Fundstrat were emphasizing is that inflation adjusted, even gasoline prices here aren't nearly the burden they were 5 years ago, 10 years ago, even at the 2008 peak. And the war is stimulating the economy, and we can see that in the earnings estimates, in the ISM, and even the jobs report. So I think the state of the consumer is one thing versus maybe how they might hear in a radio commercial or the surveys, but I do think the consumer is in better shape. So I think the retail investor will end up chasing this stock rally.
And you think as they do, that will power it higher?
Yes, but for the right fundamental reasons, because earnings estimates are higher. The U.S. Israel's relative position has really been strengthened by what's been exposed by supply chains through this war. And I think as the world investor looks for growth and they worry about growth in general, they're going to buy the U.S. stock market, which is a growth index.
We're going to talk in just a moment about international and whether, you should, not that you have to choose, you can do both, but if you had to pick U.S. versus international, is it U.S.?
I'd still be overweighting U.S. because I think if you think about where innovation comes from, whether it's in tech, healthcare, or financial services or fintech, that's really U.S. companies. And I think there was an argument the U.S. PE should derate, but the war has exposed that the U.S. multiple should be going up.
Really? So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in. The market's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.